Hi, welcome back to Accounting with Vernon, your journey towards corporate and management accounting for the Edexcel specification. So far, in my first chapter, limited companies, we have done the issue of shares. If you went through my previous content, which was the journal entries as well as the ledger accounts regarding the issue of shares. Today, I'm going to go one step forward with you. I'm going to take you through the bonus issue of shares and the rights issue of shares. If you're not subscribed to my channel so far, please go ahead and subscribe it, share it, like it, and comment so that it will be a good motivation for us to do better contents for you in the future. Now, you understood in the issue of shares, when a company issues shares for the first time, there will be shareholders. So now we are going to understand that we are looking at shareholders already in the company, which we call them as existing shareholders. Existing shareholder. So a bonus issue or script issue is when a company issues ordinary shares to existing shareholders free of charge. So a bonus issue is free of charge, which is issued to existing shareholders of the company. There are many reasons why a company will do it. Just for our understanding, we'll look at the features of what is there in a bonus issue. So the first thing that we see is there won't be any cash received. It's going to be free shares. No cash is going to come into the company. Then how do they do it? The second feature of the bonus issue will be they are going to use their reserves. They're going to use their reserves to create share capital. So they are capitalizing their reserves, especially the capital reserves, to create share capital. Okay. So the first feature was what? No cash is received. They're using their reserves to create share capital, right? Number three, it doesn't change the total equity value. It doesn't change the total equity value. Why? Because it is within the existing shareholders. You are converting your capital reserves into equity, into share capital. Okay, to share capital. Is it clear? No cash was received. You are using your reserves to create share capital, and it doesn't change the total equity value, right? Because it's within the existing shareholders. How do we do this thing? Let's assume that for our question or for our understanding, the company is already having ordinary shares of 100,000, which means we are having 100,000 existing shareholders. The directors decide to go on with a bonus issue, one share for every 5 shares held. So this is the practice that comes. You have to understand what is this 1 for 5, which means every existing shareholder is going to get one bonus share in which ratio? For every 5 shares that they held. Okay. Therefore, the number of bonus shares will be then 100,000 existing shareholders. Each one is going to get one extra share for 5 shares held. Okay, so that is going to be an additional 20,000 shares are going to be converted into share capital. Is it clear? Free issue of shares, no cash received. It's going to increase the total share capital by converting the reserves into share capital. Now, which reserves are we going to use? This 20,000 has to be taken out of the reserves because there's no cash transaction. So in one of my chapters, I have already explained to you about the capital reserves. We looked at the share premium. We looked at the capital redemption reserve. We looked at the asset revaluation reserve, right? So these are all capital reserves which can be utilized for the bonus issue. Is it clear? Very simple. Bonus issue, shares issued to existing shareholders free of charge. Ratio is there in the question of how many shares they are going to get. Once you find the number of shares, then you must know which reserves are to be used. Which reserves are to be used. We look at this in past paper questions. So, for the time being, the bonus issue is free shares issued to the existing shareholders in proportionate to what shares they are already having, and we utilize the reserves to issue the bonus share because there is no cash transactions. Clear? Good. What's a rights issue then? What's a rights issue? If bonus issue is going to be free shares, a rights issue will be a little bit different than that. Okay, a rights issue then is going to be when a company issues shares again to existing shareholders. Okay, same existing shareholders, not free of charge, at a price below the market price of a share. So that's a small trick there, isn't it? So you are issuing the shares to existing shareholders at a price below the existing market price of a share. Okay, so that may be different reasons to attract shareholders, to gain more capital, so and so. So three things are important in the definition. What is it? You are issuing to existing shareholders. You are going to issue it at a price below the market value of a share, and you will be receiving cash. Okay, same thing comes again. There will be a proportion. Let's assume the same scenario. They have 100,000 shares. The directors have decided to go in 1:5 ratio basis. So once again on the rights issue there will be 20,000 shares. Let's assume that these shares were issued at £1 each earlier. So let's assume that now this rights issue is going to be issued at 80 pence each. So it's not below the nominal value. Let's mean the market price was £1, so it's going to be issued at 80 pence each. So that's the rights issue. Then there'll be money coming in. There'll be a cash inflow. So when money comes in, your bank will be debit, isn't it? So if it is issued at the nominal value, it will go to the ordinary share capital. If there was a share premium, the share premium will go to the share premium account. Clear? A very simple thing there, isn't it? So the bonus issue, you have removed it from the reserves. Your relevant reserves will be debit. You can go through the bonus share issue account, or you can straight away go to the ordinary share capital. So the relevant reserves will be debit. Your ordinary share capital account is credit if it's a bonus issue. Existing shareholders, free of charge, utilizing the reserves. Okay. Rights issue, you are issuing the shares at a price below the market value of a share, below the market price of a share. So then in that case, you'll still get money. Bank will be debit by the amount of money that you are getting on the rights issue. You will credit your ordinary share capital and you will credit your share premium by the share premium. Is it clear? Simple steps. That was the bonus issue and the rights issue. So if you have not subscribed my channel so far, please go ahead, subscribe it, like it, comment, and share it with others. I will be meeting you soon with another content with the redemption of shares before we go into a mixed question altogether. Thank you very much, and you have a